All right, guys, welcome back to the Kwak Brothers podcast, episode 7, the lucky number 7. We're here again with Daniel, and we're going to be back here every single week. And in fact, starting next week, we're going to have a special effects going and everything. You guys will actually see a video feed because we're setting up our video studio at home right now. So for now, we're going to get audio feed only, but starting next week, we will have video feed available to us for now. So before we go on, Daniel here is going to join us for the rest of the podcast series. Daniel, what do you want to talk about today?
Today we're going to talk about silence. I'm just kidding. We're going to talk about macroeconomics. I think it's absolutely crucial that my philosophy in real estate is always this, right? And I mean, between myself and obviously Sammy, the big voice here, I call him the marketing champion of putting out content. But you know, he's between my team and I, and Sam being my right hand man, and a lot of other people on my team. You know, we did. We're closing in on 64 units, and the reason why I feel like I'm able to do that so efficiently is because I tell people all the time, you know, you got to study macro, invest micro. So, you know what? That's what we're going to talk about today, and I think we have a word from our sponsors, right?
Yeah. So we want to quickly mention our sponsor and give thanks to our sponsor here, the app Blinkist. If you guys want to read a book in less than 15 minutes, so this is how the app works. Basically, they're professional book readers. I guess that's what they are. They will read a whole book and summarize the entire book for you in less than 15 minutes, all the gold nuggets that you need. So if you're like us, if you don't have a whole lot of time to sit down and actually read the entire book,
you gotta advertise it more creatively, man. You gotta be like, imagine a world where you can take a lifetime of knowledge in just 15 minutes.
So Daniel wants to be dramatic here, which is great. So back to the point. If you guys want to read a book a day, basically, like we do, and if you're commuting a lot, if you do a lot of driving, this will be a phenomenal app for you. It's called Blinkist, Blinkist. You can actually sign up today at readwith.thekwakbrothers.com. That's readwith.thekwakbrothers.com, spelled as in readwiththekwakbrothers.com. I believe they have some promotions available for you guys as well. So that's readwith.thekwakbrothers.com. We use the app. It's a phenomenal app, and we go through usually 3 to 4 books a day just by this app. It's a phenomenal app. So let's go back to talking about the macroeconomic sense. Daniel, I think between Daniel and I, Daniel definitely has more of the big picture sense. And I have more of the detail-oriented.
I also want people to comment on the podcast. If you think Sam talks too fast and talks too loudly, please put in your feedback below. We could really use it for future references. And if I talk too quietly or too slowly, feel free to let me know too. I wish these people had effects so they could like speed up the voice. It could sound like Mickey Mouse. Right, it's like, hello, viewers, right? But no, let's talk about macroeconomics.
Yeah, go ahead and kick it off for us.
That's why you guys are here listening to this podcast, because you want to what? You want to invest in real estate, you want to become financially free, and you want to create wealth for yourself, right? If that's not you might as well turn the podcast off right now, man. We're here to make money, right? Sam,
right.
We're here to make money.
We're here for the profits.
We're here to make money, that's right? We're not going to make any money off you guys because we're giving this off for free. You're welcome. But that's your goal. That's why you're here. You're here to better yourself. So my thing is, if you want to play the game and you want to win at the game, you got to know the rules, right? You got to know the rules, and you got to know the players, and you got to know what's going on, right? The strategy, if you're playing a game of football, American football, I don't know if we have any international listeners out there, but if you're playing American football, right, the strategy for your game is going to be different if you're down by 30 compared to if you're up by 30. Understanding what you're up by, what you're down by, what is the atmosphere of the game is all about understanding macroeconomics. So, you know, when I think of macroeconomics on the real estate level, right, obviously we have to talk about housing prices, right? What are they doing? So for me, my niche is multifamily buildings. I love apartment complexes. And one of the things that I want you guys to take away when you guys are talking about investing in apartment complexes is simply this. If you're writing things down, this is what I'll write down, right? What are the interest rates doing? If you figure out what the interest rates are doing and they're predictable, you will be a phenomenal real estate investor. A lot of people talk about how it's all about acquisitional real estate. In my belief, that's what it was the last 10 years. It's always been about acquisitional real estate, which is why something like '08 happened, because the acquisitional aspect of real estate was so easy, right? I mean, like Sam, you remember people were getting people were getting loans for 125% LTV. You remember that, man?
Right. And that's, before our own career, but that's 2008, 2007 speaking to you, when banks were offering crazy loans.
Oh, yeah, man. 04, 05, 06, people were getting 5 loans for like one house.
Right.
It was astronomical. So the acquisitional real estate was very easy, right? Even like commercial loans back in the day, because you had a lot of mortgage and loan brokers who wanted to make their commission, but at the same time, the economy was doing well for a time, but people fell asleep at the wheel, right? Like, I love that movie, The Big Short. Talks very accurate about how it happened, how the debts got collateralized, all right, and all this crazy things happened. But interestingly enough, after '08, what happened is that the Obama administration, in terms of the macro level, lowered the interest rate, lowered the federal interest rate, which did what? It lowered the cap rate of all these apartment complexes, which eventually increased the value of the property. Right? If you guys again writing stuff down, here's a good rule of thumb. Every time the interest rates go down 0.7%, the property will increase by 10%. It's the elevator effect. It does the opposite. So if you're able to predict what the interest rates are going to do, you're able to time when you should be investing in certain different assets. Because I can tell you right now that right now is probably a very good time to get into apartment complexes with what the interest rates are doing now, considering that during the entire duration of the Obama administration, the interest rates were at a 40-year low.
Right. And I think a lot of people undervalue or underestimate what interest rates can do to your investment decision. And I think that's one of the reasons why in 2004 and 2005, people were making, irrational decisions about their purchases. And it's happening again. I think it's happening where we're going to see a higher interest rate pretty soon. It can climb well back up to 7-8%. We never know. But
here's what I think. Here's what I think about that. I think with a lot of the activities, and you got guys out there, billionaire real estate investors like Barry Sternlicht. You got Sam Zell from Chicago. It's my hometown. You got a lot of these different billionaire real estate investors who are all saying the same thing, saying the interest rates are going to stabilize at 6%. And because the amount of commercial loans that are going to start defaulting, we may see another crash. I disagree with the people that are saying that there's going to be a crash the very next year. But here's the thing. I think there's going to be a crash in the next 3 to 5 years.
Right.
You got to give it time for these default rates to catch up and for all these notes to collateralize. Otherwise, you're not going to have a big crash. And yes, there are a lot of different things that are affecting this outcome, this coming together, this crossroads, so to speak.
Right.
You got the dying of the retail business because companies like Amazon and online services are taking over. Do you know that JCPenney lost $1 billion the last 3 years? You know that?
Right. Yeah, the retailers are closing like faster than anything right now. Amazon and all these online retailers are taking over.
Yeah, man. I think it was either 3 years or the last 5 years. JCPenney they lost $1 billion, right?
Yeah.
They're all switching over to online services. You have all these announcements saying all these department stores are going to be closing up shop. So you have things like that are contributing, which is going to drive up the default rates of these commercial big notes that these big banks are putting together for these department stores. You're going to see a lot of those default rates go up. So I think they're going to stabilize at 5 to 6%. That's what I really think is going to happen.
Yeah, and what's interesting is that you guys don't want to get caught in the next 3 to 5 years with your pants down, right? You never want to make a bad investment decision today, and later on, when like for example, let's say you bought a commercial property, a multifamily residential property, and you have a commercial loan on it. You certainly do not want to buy it the wrong way now, because in 3 to 5 years, if you catch yourself with a bad financing, then you can get into a serious trouble, and you can potentially lose your property to the bank that has financed you, or the bank might even shut down. I mean, we might see an even worse crash than what we saw in 2008.
Here's the last thing you want to avoid, man. If the interest rates go up and you can't predict it, and the property valuations go down, I want you to imagine this. Let's say you put a bank financing situation together. You see a lot of these real estate investors that are putting everything at a 30-year amortization because they want to get good cash flow. Let me give you a piece of advice to all you real estate investors out there who are putting everything on 30-year amortizations. Don't do it.
Right.
Don't get me wrong, I like cash flow, but in my opinion, equity buildup's number one, because Donald Trump, the president of the United States, who's also a former billionaire real estate investor, still is, says in his book, The Art of the Deal, same thing with Robert Kiyosaki, all these billionaire real estate investors, you always got to protect your downside, and the upside's going to take care of itself. If you have enough equity, right? If you have enough equity, you're protecting your downside. But if you're sacrificing your equity buildup for the sake of cash flow, you're gonna enjoy short-term pleasures, right? It's like a drug addict. Sure, if you take drugs, in the short term it feels great, right? But in the long term it's gonna hurt you, right? So I mean, I don't mean to call 30-year amortized real estate investors druggies, but who knows, man? Maybe that's what it's like.
Right. And keep in mind, guys, the 30-year amortization thing wasn't around for long. The reason why it was around for a short time or was instituted in the first place was to encourage home ownership, by driving the price down. But keep in mind, you're sacrificing equity pay down for the sake of, cash flow, like Daniel said. But you want to keep in mind, you want to have both cash flow and equity payoff at the same time. That's usually
what you got to, in my opinion, you got to have equity build up first.
Right.
If you have equity build up first, everything else is going to take care of itself, right? Check this out, guys. Let's say you got $10 million worth of property, right? You got $10 million worth of property. The interest rates go up 1.4%. Your valuation is going to go down 20%. And all of a sudden, if you don't have enough equity, the bank might be coming to you asking you to refinance. They're going to be asking you for $2 million worth of liquidity. Most people don't have $2 million worth of liquidity to cough up. You either do that or you default on your loan and you lose everything. Right? Which is what happened a lot of times in 2008. So equity build up first. I mean, let's give a little example, right? So my partners and I right now, we're acquiring this 36 unit building. We're closing on it next Tuesday. It's going to be on Halloween. It's going to be a little trick-or-treat special. I don't have to go knocking on doors to get my properties. I just get them at the title insurance
We're getting rents instead of candies. That's what we're doing.
No, dude, forget rents. I want the building, man. I want the equity.
We're going to go door-to-door collecting rents instead of candy. That's what's going to happen next Tuesday.
Like trick-or-treat, mother effer, right? All right, so check this out. So we're closing on this 36-unit building, $1.5 million purchase between my partners and I. Right, and we're increasing the equity, so we're raising the rent $200 every single unit. That's what I look for, right? When I study macroeconomics and what it's doing now, I know what I'm going to do on a micro level. What I'm doing on a micro level is very simple, ladies and gentlemen. You have to buy apartment complexes right now at a Class B, Class C level that it's underperforming. Especially with what the interest rates and the federal markets are doing right now, considering what may happen in the next 3 to 5 years. What we are doing right now, ladies and gents, real estate investors of all ages, size, sex, religion, I don't care what you are, black, white, pink, green. What's going to happen is what we're raising the rent $200 every single unit times 36. You do that, the math on that, I don't know what the exact math is, but last time I did it was around $19,100. If you buy or sell at a 10% cap rate, that is the difference of $190,000 in property value.
Cap rate goes up.
Right, $200,000. We're also putting capital improvements. Right now, I'm telling you, what you got to focus on if you want to make a lot of money in real estate is value creational real estate, ladies and gentlemen. The age of acquisitional real estate is done. It's over. A lot of these regulations make it harder to acquire properties. Not saying that it's completely dead. There's still a lot of value in it. But my personal philosophy is value creational first. So here's what's going to happen. We're going to raise the rent, which is going to increase the NOI, increase the value of the property. We're going to put capital improvements to it. And within the end of 3 to 5 years, what we're looking at most likely is an increase by $800,000, $900,000. Our building will most likely be worth $2.5 million, right? And our equity by then is going to be 50 to 60%. We're going to have 50, 60% equity by year 3 or 4. I mean, that is astronomical. Right. Talk about protecting your downside. I don't know. What are your thoughts, Sam?
I think that's phenomenal, and that's exactly why we have Daniel, and that's why that's why I convinced my mom to have a second child, and here we are. Daniel's the brother.
We're like 18 months apart.
Yeah, right. So, so this is wonderful, and Daniel's shared us a lot there. If you guys are not picking it up, re-listen to this podcast, obviously. But we can see another disaster coming in about 3 to 5 years, and you got to protect yourself. You have to keep caution, protect your downside, like Daniel said. And in case there's a disaster, and I want to mention another sponsor and I want to say thank you to another sponsor that we have, which is My Patriot Supply. they are actually giving away a 72-hour emergency food supply.
Oh, shoot. Oh wow.
And yeah, it's amazing. So this is super important. So let's say, for example, the next year, for some reason, North Korea army decides to attack us, and all of a sudden, the entire power grid of the United States go down, and pretty much all the shelves in these stores are cleared. There's no food and no water. What do? Right? You don't want to be going out there hunting for food, right? So what our friends at My Patriot Supply has given out is a 72-hour emergency food supply. You can purchase it. It's really cheap. We bought ours for $15 for the 72-hour emergency food supply. It was so good that we actually bought two, one for Daniel, one for myself. I don't want to share with Daniel. Daniel should have his own little
We got a total of 144 hours of emergency food supply. After that, it's every man for themselves.
Yeah, exactly. Right? But usually most national disasters last no more than 3 days. I mean, if it gets severe to the point where we have a full-scale war in the United States, then yeah, we may have to do something about it.
Do you know what's in these emergency? What's in this, man?
Oh yeah, so they're very tasty. We got like mashed potatoes. We have very vegetable oriented. And what's surprising to me is that a lot of these food are 25-year shelf life, meaning for 25 years you're still okay. Your food will still go okay.
Meaning if the food was created when Sam was born, he could still eat it today.
Right. So
that's what it means, guys.
So I like this because it reminds me of my old days in the Army when I used to eat MREs, meals ready to eat. I heard these food taste better than the MREs that the Army give me. So where do you go to get this food and some of the supplies and natural disaster supply? Go to preparewith.thekwakbrothers.com. So that's preparewith.thekwakbrothers.com. PREPAREWITH. TheKWAKBROTHERS.com. That's preparewiththekwakbrothers.com, and you'll get your 72-hour emergency food. Also, I believe there's also a year worth of emergency food supply. I believe it's like $1,400.
A year's worth of
food supply. Yes.
See, why don't they just do this with the people in Africa? So you got $1,400. You can literally feed an entire village.
Right. So that being said, Daniel and I ordered one for each of us. I think it's a great deal, and just in case anything would happen, we're going to keep it in our car. We get stranded. Who knows? But we just want to prepare for those natural disasters.
I know what I'm going to use it for.
Right.
I'm going to be looking for properties, and if I don't have time to stop by a restaurant, I'm going to be eating these.
So, like we were saying, in 3 to 5 years, we can see another market crash. This might be even more severe than 2008.
Well, here's the thing. Is this being posted in the Real Estate Investors Facebook group?
That too, as well. Yeah.
Okay, I don't ever talk to those people, but I really should. If you're listening to this podcast, I want to hear your thoughts, man. Comment down below what you think is going to happen in the economy 3 to 5 years. I may learn something, I may debate with you, I may disagree with you, but whatever it is, you better come with some solid facts and data, because I'm very curious to see other point of view. I've met people who say it's not going to happen for another 8 to 10 years. I just spoke with an attorney, right? #1 attorney in Chicago. I was hanging out with him the other day, and the guy is like, man, it's going to happen 2-3 years, man. It's going to happen real soon.
Mm-hmm.
It's going to happen real soon. So if you're an attorney, man, I think there's going to be a lot of money in being a bankruptcy attorney 2 to 3, 5 years from now. But we can all agree it's going to happen soon, at the minimum 5 years. I think it's astronomical. But here's the thing. Every other American is going to say it's a problem. For those of you listening on this podcast, I want you to repeat after me. That is not a problem. It is an opportunity. Literally, look at yourself in the mirror right now. I don't care if you're driving. I want you to pull over, look at yourself in the mirror and say, this is not a problem. This is an opportunity. And I also want you to tell yourself, I'm going to go ahead and email a check to Daniel for $10,000 just so that he can go to Hawaii, right?
I mean, we're giving you guys a fair warning, folks, and we're just making sure, like Daniel was saying, protect your downside. This is going to happen. It's inevitable.
Well, who knows, man? Even if it doesn't happen,
right?
You still want to protect your downside,
exactly.
No matter what. And this is a podcast, right? I mean, this is two guys who is well versed in real estate. We want to share ideas with you, but you know what, man? Here's what we're saying. At the end of the day, all the data, all the evidence, all the people that I talk to, all the people that I have in my network, and you're looking at all the way from folks who've been doing real estate for 40 years, property managers, right? I got contractors, I got economic analysts, I got the #1 attorney in Chicago, who was one of my very good friends in my network. We're all saying it's going to happen, man.
Right.
We're all saying it's going to happen. It's like Noah. right? It's like Noah and the ark,
Right.
right? Are you gonna laugh, or are you gonna be one of the animals, right, in the ark? That's what I want you to be, man. I want you to be one of my animals, right? I just want to be Noah for a change, right? So, but I want you guys hopefully to be inspired to go out and do some research, man. There's and the bottom line is this. Here's why we even have this podcast. There's way too many real estate investors out there who are doing this without any education,
right?
Without any knowledge, and they're getting hurt. They're getting hurt. Sure, man. They might post a check for $80,000 they made on one deal, but I guarantee you they did 8 or 9 other deals in which they didn't make that much, or maybe they even lost money, right? And they may have to use those profits, right, to pay back the investors of the deal they lost money in, right? So get educated, folks.
Get real educated. Yeah. So we're gonna wrap this podcast up we got one more sponsor to thank, and that's our lawyer and accountant, Mr. Mark J. Kohler. He's got a very special QuickBooks training that actually I personally took myself. I mean, if you are using QuickBooks and QuickBooks is scary to you and you're literally confused what to do on QuickBooks, you can get a QuickBooks training for very, very nominal price. And Mark has prepared that for you at our site, QuickBooks.thekwakbrothers.com. That's QuickBooks with an S at the end, .thekwakbrothers.com. And just in limited time, Mark J. Kohler, our attorney and accountant, has a special training just for you for QuickBooks training. It's going to help you a lot. Save yourself time and energy. Instead of attending some local community college QuickBooks training, you can watch this training on demand at your own time, because we get it. We're all busy. We're all entrepreneurs. We're trying to get our own way as far as our time. Make sure you get your QuickBooks training. So,
hey man, let me before we end, let me say something about Mark, man. That dude he's a beast.
I agree.
He's a great dude, man. There's not a lot there's very few people in the world who has the knowledge that he's got.
I agree. Yeah.
I mean, that's why we use him, man. He's phenomenal. He's phenomenal.
Right. All right, guys. So that's pretty much it. This has more been a macroeconomic sense, but really more of a warning for you guys out there. If you're not careful what you're doing the next 2-3 years.
Well, we don't want to scare these people, right?
Well, we don't want to instill fear, but we want to instill some logic and rational preparation.
It's the apocalypse, man. You better grab your pitchforks.
Oh, better get your 72-hour emergency food kit, right?
Oh, there you go. Hey, remind them again. Where do they go to get that?
Yeah, so it's preparewiththekwakbrothers.com. We don't want to turn this podcast into an advertising frenzy.
I'm trying to get paid.
We don't want to turn this into an advertising frenzy. We want to actually get you guys learning real estate investing, but we just have to thank our sponsors that without them we're not doing. We can't fund our time here with the podcast. So,
well, hey man, we sponsor them because not because we're trying to get paid, man. We're making enough money in real estate, right? We're making tons of money with real estate, but it's just things that we endorse, right? Like we love it. We just know that your business would be better with a product like Blinkist, right? Your mind would be better with a product like. I mean, come on, guys, reading a book in 15 minutes or less—that's awesome, right? And we just know how much of an impact that Mark has made in our business career.
Yeah.
We just want to share that, man. We just want to share that value, all right?
Yep. So we're going to wrap this podcast up, guys, by saying thank you so much for tuning in. Next week, let's go and talk about some analysis, finding where to find deals. I'm going to share some of my favorite sources, where to find real estate deals, and you guys have to tune in. Be sure to subscribe to our YouTube channel, and we just found out our SoundCloud is limited, so SoundCloud is gone now. But go to our YouTube channel. That's youtube.com/C/the Kwak Brothers. Again, that's youtube.com/C/the Kwak Brothers. Check it out. Subscribe to our YouTube channel. We'll have new podcasts coming out every single week. We'll have videos out for you as well. And I think a lot of you guys have been learning tremendous amount of information on real estate investing. And as always, Daniel and I are looking for qualified, coachable, humble, eager, motivated trainees to work with nationwide. So if you want to work with us personally, like you want to get us on the phone, you want us to fly out there to where you are and help you personally, join our nationwide real estate investment group that has taught us, all of us, me and Dan, and the rest of our team that's within the brand of the Kwak Brothers. Join us, and we will love to show you and get you connected to our group so you can do more real estate deals. You can potentially double or triple your business revenue. We can help you achieve that. So make sure you subscribe to our YouTube channel. We'll put all the things that you'll ever need to connect with us and learn with us at the bottom of the link description. If you're listening to this via our website, you'll have information down there as well. So guys, thank you so much for tuning in. Thank you so much for subscribing, and we will come back next week to provide you even more and amazing podcasts. I'll see you guys next week.
Make us proud, man. Go make some money.
There we go. All right, guys. Take care now.